In this video, we will explore 5 dividend stocks that are poised to withstand rising interest rates. These interest rate hikes have dominated the financial conversation ever since the Fed began raising the Fed funds target rate in March of this year. The Federal Reserve has a dual mandate set by Congress to keep prices stable and maximize employment. The Consumer Price Index has soared to levels not seen since the 1980s. There have been several factors that have led to the yearly inflation rate to hit a high of 9.1% in June, including ongoing supply constraints related to the COVID-19 pandemic and the sanctions on Russia following its invasion, as well as rising wages in a frantic attempt to bring workers back after COVID shutdowns. And additional government unemployment benefits fueled a situation that has led to over 1 million jobs left unfilled due to a lack of workers. In order to tame inflation, the Federal Reserve has raised the federal fund rate 6 times already in 2022. With a higher Fed fund rate comes higher borrowing costs. This would make businesses that are heavily indebted need to refinance expiring debt or typically use debt issuance to fund growth likely experience some pain, which could lead to a recession. There are, however, sectors or individual companies where rising interest rates could be a tailwind and fuel additional growth. So let's jump in and examine 5 dividend stocks to own to fight these rising interest rates. First up, let's look at JP Morgan Chase. JP Morgan was originally founded in 1799 as the very first commercial bank in the US. JP Morgan has stood the test of time and survived every economic situation imaginable. JP Morgan competes in every major segment of financial services, including consumer banking, commercial banking, home lending, credit cards, asset management, investment banking, and many others. JP Morgan reported third quarter earnings results on October 14th, 2022, in which revenue grew 10% to $32.7 billion. While earnings per share of $3.12 was lower than the prior year, but still above analysts' estimates. JP Morgan currently yields 3.62% dividends and has raised its dividend for 11 consecutive years. With a projected payout ratio of 35% for the year, the stock's yield is twice that of the average yield of 1.8% for the S&P 500. Next up on the list is Synchrony Financial, a consumer financial services company that operates 3 core business segments, including payment solutions, retail credit, and care credit. The company offers its range of services to its customers, including but not limited to private label credit cards, small-sized business credit products, promotional financing for higher-priced consumer goods, and promotional financing for healthcare-related products. The company had its IPO back in 2014, and since then, Synchrony Financial has been valued at $16 billion, with an annual revenue of more than $10 billion annually. Synchrony Financial reported its third quarter results on October 25th, 2022, in which revenue grew 22% to $2.9 billion. Overall earnings per share of $1.47 was unfavorable compared to the $2 in the prior year. But the third quarter of 21 saw a massive reserve release that added 33 cents to the results. Earnings per share for the most recent quarter was higher than expected. While Synchrony boasts a smaller overall dividend payout than does JP Morgan Chase at 2.59% annually, its share price to earning ratio is nearly half as much at a super low 6.38. A lower PE value means that an investor is paying less per dollar of a company's overall earnings, which can make this stock an attractive option. Next on the list is another financial institution, KeyCorp, stock ticker KEY. Now, if you haven't already noticed, there's an ongoing trend with these stock picks, all falling in the financial sector. But that really shouldn't come as a surprise, since rising interest rates means that banks can loan out funds at increased rates, dramatically increasing their overall revenue, all while their expenses remain relatively flat. KeyCorp has been in business for over 190 years and has transformed into a leading regional bank with over $190 billion in assets. The company has operations in 15 states, providing customers with over 1,300 ATMs and 1,000 full-service branches. KeyCorp offers personal, small business, commercial, and corporate banking solutions in addition to its wealth management. The $17 billion company produced revenue of $7.3 billion last year. The company released earnings results on October 20th, in which it saw revenue growing 3.5% to $1.89 billion, while earnings per share of 55 cents compared to the 65 cents in the prior year. However, as with our last stock pick, last year's results benefited from reserve releases. The dividend yield for the stock is 4.3%, with an expected payout ratio of 35% for the year. It is likely that KeyCorp's dividend growth streak of 11 years will continue well into the future. Coming in at number 4 is TD Bank. Stock ticker, TD. TD is one of the largest Canadian banks with nearly $2 trillion in assets. The company's major segments include Canadian retail, U.S. retail, and wholesale banking. While based in Canada, Toronto Dominion generates nearly a quarter of its annual revenue from the U.S. While TD does have physical branch locations in several of the eastern U.S. states, in the U.S., the company is probably best known for its financial services offered through its online brokerage platform, TD Ameritrade. The company is valued at $118 billion and produced revenue of $33 billion over the past 4 quarters. Toronto Dominion reported third quarter results back in August of 22, and Canada has also gone through its own rate hiking cycle, with the Bank of Canada raising rates 6 consecutive months since March. The size of the most recent increase was 50 basis points, so not yet at the level of the Fed. As a result, net interest income reached 7 billion Canadian dollars for the period, up 17.3% from the prior year and 10.5% from the previous quarter. Now, unlike its American peers, the Canadian banks did not cut their dividends during the Great Recession, but instead chose to pause their growth. Toronto Dominion has raised its dividend each year for the past decade. Shares currently yield about 4.53%, with an estimated payout ratio forecasted to be about 42%. Last up on the list is the Bank of New York Mellon Corp. Stock ticker, BK. The bank was founded after the American Revolution in 1784 and was the first bank ever to make a loan to the U.S. government. Since that time, the company has grown to be valued at nearly $35 billion and now generates annual revenue of $16 billion. The company offers global investment services with the stated goal of helping clients manage assets throughout their investment lifecycle. Bank of New York Mellon reported earnings results in October, in which it saw revenue for the period was $4.28 billion, which was 5.9% higher than the prior year. Adjusted earnings per share of $1.21 topped the prior year's results of $1.09. Both top and bottom line results were higher than expected. The bank is expected to grow its earnings per share by 6% per year through 2027. The company currently has a dividend growth streak of 12 years and offers a yield of 3.59% today. The payout ratio is expected to be 35% for the year. With the broad S&P 500 losing 15% over the course of the last year, you can often protect and fortify your investment portfolio with defensive stocks such as these that are poised for outsized gains imposed by the current economic climate of high interest rates. These financial companies post larger than average dividends and are positioned for additional gains as new loans can be made earning higher and higher interest rates. If you enjoyed this video, consider subscribing for more ways to either grow your portfolio or simply retire and live off the earnings generated by high-quality dividend stocks. And as always, I'll see you all again next time. Thanks.